Welcome back to the Trading Justice Podcast, episode 324. I got an absolutely amazing and special guest here today, David Keller, a former certified market technician and president and chief strategist of Sierra Alpha Research. He's also the past president of the Chartered Market Technicians Association and was most recently served as a subject matter expert, we like to call SMEs here, for behavioral finance. And you can follow all of his thinking on his blog at marketmisbehavior.com. David, I was going to do a lot more in terms of your intro, but I had to cut it short a little bit so that we could get into the podcast. You have an absolute wonderful, wonderful record out there helping people, understanding money, understanding the markets. How are you doing today, my friend?
I'm well. It's good to join you guys. Pleasure to speak to you.
If we read your whole bio, that would be the entire Trading Justice podcast.
That would be the podcast.
Then we can do a second episode with all the discussion.
No, we're just like, okay, 324 is David Keller's bio, and then 325 next week we'll talk to David himself.
I was going to put an audiobook on it, actually. Put it on, yeah. But David, it is an absolute pleasure to have you with us here on the Trading Justice Podcast. So thank you so much for coming. David, I want to start with behavioral finance. You're obviously a subject matter expert on behavioral finance and understanding how that impacts the market. How would you describe behavioral finance to our listeners?
Yeah, absolutely. And behavioral finance as a discipline or as a practice has really evolved over the last 20, 30 years. And it seems to have accelerated in the last decade or so. And what it's doing, it's essentially all about decision making. It's all about how we make decisions. And behavioral finance is how we make investment decisions. But what's funny is a lot of the biases and decision-making challenges we talk about affect our decisions, not just with our money. We make a lot of decisions during the day, from what we're going to purchase, from a car we're going to buy, to what groceries we're going to use, which route we're going to take with our car. All those things are driven by how we're hardwired as humans. So behavioral finance is all about unpacking the reasons and the justification for why we tend to make decisions with money, and to minimize that impact on our decision making, help us make better decisions with our investments.
I call it a relationship to money, and basically how our personal relationship to money. And a lot of times when we have that job and we have that career and we work for money and we exchange time for money, money becomes something that it most likely shouldn't become. In terms of the investor's relationship to money, how should we approach money from an investor-related perspective?
It's a really good question. And I'm just going to make up a statistic, but I remember hearing something that the number one argument source for married couples is money. It's a financial argument, right? Because it's so intimate. It's so part of all the things that impact us with raising a family and having shelter and food and all of these things. So I would say, how we relate to our money, it's very important. And I think what you've hit on when you call it a relationship is that it's an emotional relationship, right? It's
Absolutely.
not just, as much as we want to take emotions out of the picture, the way that money motivates us and it affects us, and it feeds the sensations of fear and greed that impact our ability to make decisions. So in general, what I try to do is help people develop more of a positive relationship, more of a positive, constructive relationship with their financial situation. And whether it's individuals and thinking about how to retire gracefully and how to plan ahead, how to have a good trading plan, but also institutions, up to money managers that I've worked with, to, they run into the same challenges of how they relate to their portfolios and their clients. And I think all of that, you can have a negative bias or a positive bias. And the more of a positive, constructive bias you have, in the end, it allows you to have the freedom to make better decisions, which is what I try to help all of my clients do.
Well, every single one of us have this relationship to money, and some of it is from an investor trader, some of it's from a consumer's perspective. And I do believe that it's a lifelong journey in really kind of, understanding how you are impacted by money and our own personal relationship to money. I mean, David, I've been a trader for 15 years, and even today, sometimes I still get caught up in the money argument, in the money conversation, because it's like, we always have to work on this relationship. And for me, money should be about investments. It should be about, putting food on the table and having a great life. And it's certainly what provides, us having those things. But I honestly believe that we've gotten away from what the purpose of money is to a certain extent in society. We should put investment before purchasing certain things. And as a consumer-driven society, the relationship that consumers have to money is just what can they buy instead of how can I create velocity to money, compound gains, put the investment first, sacrifice a little bit in the short term so that you can have a better long-term type perspective. I want to talk about behavioral finance, both from the macro perspective as well as from the just how it impacts us on an everyday. But from a macro perspective, whenever I'm teaching people, market cycles, business cycles, I really start with talking about behavioral finance and how, these cycles happen for a reason. Does behavioral finance, in your opinion, really have an impact on the market going up and the market going down?
Absolutely. And technical analysts, and that's my background professionally is as a technical analyst. We've for decades, if not centuries, have been using charts as a way to visually represent market behavior, really investor sentiment, right? What is the people vote with their capital, they vote with their money. And so by analyzing where funds are flowing, you can analyze where people are at and how they're thinking about the investment landscape and long-term opportunities. So we often, learning technical analysis, you learn things like the markets are driven by fear and greed. So fear pushes the market lower, greed pushes the market higher. I would counter that they actually are driven 100% by fear. And it's either fear of losing everything on the way down or fear of missing out on the way up.
Yeah, FOMO on the way up.
Exactly. And we found that in the last couple of years for sure. I mean, it's felt like just the market has continued to drive higher. And if you missed out on some point, there was just never a point where you felt like you could buy into it. And so it ends up being super, super frustrating. But you find that there's this, the volatility that we see, the capitulation, it feels like there doesn't feel to be any, short-term, just steady eddy movements. It tends to be just all in, all out. Everyone's panicked going up, panic going down. And I think that shows you where investors are at psychologically, really, I would argue since 2000, when we've had a number of, really challenging periods from a secular bear market and then a secular bull market that was really difficult to trust in the way. So now the last 18 months, which have just been frustrating no matter what side of the market you've been on. So overall, I would say that the nerves of market investors overall are fairly raw at this point. And I would say that emotional reaction to that fear of loss is what is.
And think about just the last 6 months, David. I mean, you coming out of November and December where we have a 20% clip in the S&P 500. We have a V-shaped recovery back up, 16, 17, 18%, kind of hitting those all-time highs again. And then all of a sudden we get that in May coming in again, and market volatility, worst May in the last 9 years, just today, starting out in June, we have some more market volatility. I mean, it's this bipolar type of market that's going on right now. And I do believe it's driven. I love what you just said there when you said, Matt, it's not just the fear of going down and losing money and losing everything you made, but the fear of missing out as well. And that's
he said,
this volatility.
Markets are 100% driven by fear. I love that quote so much. I'm stealing it from you, David. And I'm going to make it my own. So years from now, I'll say, listen, I've been saying markets are 100% driven by fear. That quote is so good. I just got to steal it from you.
Yeah,
you're welcome.
He's going to edit it out of the podcast.
Yes, you never said it. I've been saying it for years. Markets are 100% driven by fear.
But when you look at it, though, the fear-driven marketplace, and especially the last few years, I made the joke the other day, and I can't remember who I was talking to. We were looking at Disney, and I'm like, the last couple of years, all of a sudden, Disney is a growth stock, and it's really kind of this taking these value approaches, and the valuations are so far out of whack, really over the last 3-4 years, that it's almost like just buy, and then dump, buy, dump. It's been a very difficult last, year and a half, really since the beginning of 18 for a lot of investors out there. Traders have loved it. The traders love the volatility, but for the investors out there, it's a little bit of, a lot of fear. What's going to happen next? What's going to happen next with the trade wars? What's going to happen next with Europe? What's going to happen next with slowing growth out of China and slowing growth in the US? And there's all this fear that's really kind of driven. And I was just recently, this past week, I was out there teaching a great group of students down in Phoenix, Arizona. And I asked the group, I said, hey guys, listen, where's this market headed over the next couple of years? Just give me your opinion based on your own perspective, based on your life, based on your whatever it is. And David, half the class was, yeah, the market's going to be good, and half the class was, oh, the market's going to be bad. And when I would ask them, well, what's the analysis, right? What led you to that analysis? And it really broke down from two perspectives, David. It broke down political affiliation. That was one. And number two, it was whether they were secure in their job, in their career, something along those terms. And they just like, oh yeah, the market's going to have some volatility, but it's going to be great. We're going to have slowing growth. Increasing growth. And it's like, that's not the analysis, right? The analysis isn't if you have a job, or if you are spending money, or if you're a Republican, or if you're a Democrat, or that's not the analysis, right? How do you get people to overcome their own biases that are internalized for decades, most likely, to get them to look at the truth of the marketplace?
It's a really, really good question. And I would say when I coach, with my firm now, I coach a lot of investment advisors. So people that manage money for high net worth individuals, others, and just helping them bring more discipline to their investment process. And when I work with them, I think I say the word discipline at least 100 times an hour, because that is what it's about, right? Because what we just talked about, the volatility, the fear that drives it, the emotional reaction you have to market movements. If you're managing things based on your emotional reaction or on your wishful thinking outlook of what you think could happen, then you're just opening yourself up to all of these bad potential decisions you could make. So what I always coach people to do is have a very disciplined entry process and a very disciplined exit process. And the way I would think of both of those is in terms of an entry process, it's all about a checklist. So I'm a student pilot, and I basically use the same technique you would use when you're prepping a Cessna to go up in the air. It's here are the 10 questions you are going to answer. And then once you've done that, you have earned the right to decide whether or not you can buy this stock at this point. And unless
go through the process, right?
It's all about a process, and it's a consistent process. So tomorrow you're going to look at a different name and do the exact same thing. And what that does is it forces you to apply the same consistent discipline and forget about what you think could happen and what tweet might come out or what trade issue might come out. It's all about a disciplined, consistent process. And that's what drives your decision.
Those variables exist every day, obviously. I mean, whether you're talking Obama in office, Trump in office, obviously the Twitter is going to have right now is going to have a little bit more of an impact than when Obama was in office. Those variables do exist. And we cannot get too caught up in the variables because they've existed every second of every day throughout the entire history. And that's why I believe in technical analysis so much, is that as those variables constantly play out in the market, I've noticed how the exact same variable, the exact same tweet, or the exact same economic report, the market will respond to it differently if the market's at a resistance point a little bit overextended versus at a support level a little bit overextended to the downside. And it's just these market behaviors play themselves out over and over and over again. From a technical perspective, you're obviously one of the better technicians out there, David. That was my transition into the technical aspect of it. But you're a certified market technician. You were the president of the I want to get it off my head. The
CMT Association.
That's right, Certified Market Technician Association. First and foremost, how did you even become familiar with this, with being a CMT, and why was that important for you to get the title to a certain extent? Because Mark's a technician, I'm a technician, Tyler Craig, who is a certified market technician, you're a certified market technician. We all understand technical analysis, but you got that title, you got that paper. Why was that important for you?
Yeah, great question. So I have the very non-traditional background of studying music and psychology as an undergraduate before I got into finance. And I essentially was burnout from studying orchestral conducting. And I was taking a break before I went back to conservatory. So I went into, I worked for Bloomberg in New York. And then I finished the music part. So what's funny is when I was there and I was learning all the different methodologies, how to analyze, markets, stocks, economy, the Fed, bond math, all of that. When I first looked at a price chart, it immediately clicked for me. And your listeners, if they're musicians, you'll know that there's a mathematical basis to music. So that the mathematical relationships of market movements immediately clicked for me. And also musicians are all about pattern recognition. So learning a musical style, learning an instrument is all about muscle memory and recognizing for this period with this style of music, here's what will logically come next. Here's what I should anticipate as a musician. And as an investor, that's what you're doing. You're basically saying, here are the inputs I see. Okay, here's what's probably going to happen next. And that, based on your analysis of market history and your knowledge of market dynamics. And then studying psychology was a perfect preface for doing technical analysis. So when I learned that there's a discipline that was all about getting inside of other investors' heads and trying to understand their motivations, it made perfect sense to me. So somehow my background studying music and psychology was a perfect segue to analyzing stock market movements through price. So for me, the CMT came a couple of years after, and I was in New York with Bloomberg, and learned about the CMT, started studying for it, eventually ran the New York chapter, and then moved on to join the board of directors. But for me, what was most helpful was the structured approach to learning technical analysis. Mm-hmm. So I kind of learned some things on my own, and I had met a number of clients who were on trading desks in New York and Connecticut, a lot of hedge fund guys. And, not to throw any of them under the proverbial bus, but I would say not a very disciplined way of applying the technical toolkit at times. No. So I was like, there's got to be a better way to understand how to do this. And so the CMT was great because it forces you to start from the very beginning. What is price? And then go all the way down through how are you really going to apply this at a portfolio level or, to determine a trading plan.
I've never taken the test.
That's what was most helpful.
Yeah, I've never taken the test, but just in preparation for this interview, kind of looked at some of the breakdown of the questions and whatnot, and indicators, secondary indicators. It was all just technical analysis. And I remember, studying I went to law school in a different life there, David. And
yeah,
the one thing law school taught me is I didn't want to actually be an attorney, but I do remember studying for the LSAT, and the LSAT just really has nothing to do with law school, has nothing to do with anything. Is it like literally nothing? And the bar literally has nothing to do with the practicing attorney. And, the test that insurance agents have to take on every 2-year basis doesn't really have anything to do with being an actual insurance agent. But I was looking at this test and it was like, yeah, this is a legit test. This is really test your technical skill set. I was actually very, very impressed by it.
Yeah, what's so funny is when I was studying for the CMT, which is sort of early 2000s, my wife was we lived in New York at the time, tiny New York apartment. We didn't have kids or anything yet. And my wife was studying for the CPA exam at the same time. So she's trying to become an accountant. I'm trying to be a technical analyst. And what was so funny was her experience was very similar to yours with the LSAT. She was learning things that she said, I have absolutely zero use for this, but I have to learn it from the exam. And on the other side of the table, I'm learning stuff and I'm going into the office the next day and I'm applying it real time to the markets. I'm like, yep, that's why this is going up. That's why it's going down. So it felt like such a great, practical, useful toolkit that I feel like I came out of that experience a much better investor than going in, which was probably the best testament to that exam, I would say.
I got a 2-part question for you. Part number 1, you have an awesome blog over there, marketmisbehavior.com. And my first part is, you use a lot of analogies when you're trying to explain a concept. And like you were doing the one on the misperfection, where you scuffed your shoe. And I love the picture of it, by the way. And as I was reading it, I saw that picture and I'm reading and you're teaching through the analogy and you're storytelling. But you're storytelling in the way to get to a point. And you did another thing with your pilot one and your checklist. And I just felt it was a wonderful way to get your point across to the end user. So when you're dealing with new people, because a lot of people that read that blog are probably fairly new to the marketplace. Is that correct?
Definitely, yep.
They're not the CMT. They're not the professional trader, right?
Correct.
How do you go about teaching and getting new traders to understand these very complex ideas?
It's a really good question, and thanks for recognizing that. I've often found that, and I think probably it comes from the fact that most of my career I've spent at shops where they're not filled with technical analysts. It's not like I'm working for a technical shop and I have a bunch of technical analysts around me. So at Fidelity, I was working with money managers who were fundamentally oriented and not looking at charts all day. At Bloomberg, it was a lot of developers and clients that were doing other things. So I've always tried to find ways to relate what we do when we're analyzing price movements and investor psychology to other things that people have done. And the good news is, between music, sports, flying airplanes, and the things you mentioned, I've often found there's some way that we can kind of connect it. And I would say that's it. A lot of times people think of investing as something different. It's a skill set that they have to figure out. Either they've done it and they have the experience, or it's this big unknown. And I find that, and again, as much as professional money managers are pretty good at a lot of things, they're still making, pretty dumb mistakes at times, to be honest with you. They still need a lot of reminders about how to go through the process and how to do it. So for me, it's all about reminding people that the way that you can be a good investor is to make smart decisions and have an awareness of what's going on around you. And so the name of my firm, Sierra Alpha, comes from an aviation term for situational awareness. And it's all about, when you fly an airplane, you have to pay attention to what's going on outside of the cockpit. Otherwise, you'll fly into a mountain or the ground or another airplane or something and your flight very quickly. And so, I teach people that it's all about having an awareness. And that means, using lessons of pilots, using lessons of meditation and mindfulness, but just ways to recognize that you have to just have your eyes open and your awareness open to what's going on around you. And once people do that, things start to make a lot more sense. And I think investing and trading feels a lot more accessible. And that's kind of the goal of my conversation.
You could have used any analogy in the world. Matt and I are both scared of flying. And so of all of the analogies in the entire universe you could have used, it had to do with mechanical and pilot air in an aircraft.
Yeah, just keep talking about that piloting and that air travel. It'll make us feel lots of I was going to ask you about it at the end, but in terms of, the fundamentals versus the technicians, okay, you talked about how a lot of the advisors, a lot of the institutional level, they're still really kind of working on fundamental analysis. And, I like to consider myself a little bit of a value investor, that Warren Buffett approach, dividend paying, do some covered calls, take the aggressive out of the equation. I think there's a room in a portfolio for growth as well as value. It's just a matter of what percentage and understanding who you are. But the question I want to talk to both you and Mark about, because I want to get Mark your take on this as well. As we've moved into the technological era, and a lot of the price action we see on a daily basis is driven through algorithms, is the importance of valuation and fundamentals and fairly valuing a company based on intrinsic value versus extrinsic value, PEG ratios, P ratios, debt to income, earnings per shares, everything we look at from a fundamental investor, are those becoming less important as technology and algorithms have really kind of taken over from the large percentage of the total transactions on a daily basis?
I would think of it this way. Is it still relevant? Absolutely. I would say the way I would think of it is this. If you're looking at a large cap U.S. stock, if you're looking at Alphabet or Facebook or Johnson & Johnson, the chance that you will develop some unique, crazy, independent investment thesis that no other investors have thought of, I would say is pretty remote, because there are a lot of people trying to do what you're trying to do. And you have to remember that a lot of the discipline you just described really was born, 100, maybe a little less years ago, right? I mean, it was designed in the 20s, 30s, 40s, 50s, and so the market was very different, and so there was a lot less transparency, there was a lot less information, no computing power, so the big institutions had an information edge that you did not. So using some of those tools and getting the information you could was really valuable. I would say for very liquid U.S. names, for example. It's very transparent. I don't think big institutions have much of an edge anymore. They really don't, because they don't have an information edge or access that you probably would not. So the way I think of it is, the less transparent, the less liquid, the less off the grid that you can go, the more opportunity there is for inconsistencies and irrational behavior to be reflected in what's going on. So a lot of times, if you're looking for places where you can really have an edge, I would go to smaller cap in the U.S. It's less widely covered, right? So we had one analyst that covered U.S. large cap life sciences companies, right? That's a really deep, narrow thing. But then we had one analyst covering like the entirety of Africa, right? So it's all relative in terms of what you can do. So emerging markets, frontier markets, less liquid names, smaller markets, less transparency. That's where there's still very good opportunities, I think, to find value that most investors will not take the time or effort to do so. And the information is more and more widely available for individuals, which is what's pretty cool about it.
Everybody knows Apple. Everybody knows.
That's right.
Matt, and this will make sense to you, Matt. I come from a sports betting background, David.
Mm-hmm.
And I always used to say when I was trying to teach people the basics of sport betting, something along that lines. If you're going to try to find an edge on the line on Notre Dame versus Michigan, how many people are following Notre Dame, Michigan? Everybody.
That's a good line. I don't care what it is. It's a good line.
But if you're trying to find a value in a good opposite, in Tulsa versus North Texas, well, how many people are following that game? Not very many. And so the bookmakers have to make a line on everything. And so you try to go to those big names, everybody has the information. Go to smaller games, you can find an edge.
I remember doing some of that with my brother back when I was in school. And we would research the North Texases and those smaller schools quite a bit, because that's where the market maker, i.e. the bookie, right? That's where they make mistakes, is on those types of numbers. And everybody, if you're tracking USC Notre Dame, well, everybody's eyes on that, right? And that's kind of the Disney versus the small cap type argument here. And by the way, I'm not saying it's a bad thing, not at all. 30 years ago, I never would have been a trader sitting here in front of my home doing my thing, talking to David Keller and my brother about trading and investing. I'd be an attorney in some office down in Salt Lake City. I'm very happy about the technological changes over the last 30 years. In terms of behavioral versus fundamental versus technical analysis, looking at these three forms of analysis, I'd like to kind of think about them like this, David. I want to get your take on it, okay? Mm-hmm. When I'm talking to somebody very, very new to the marketplace, I'm talking off the street, green, maybe has a 401k, but doesn't even understand what's in it type thing, right?
Right.
And I give them the scenarios like this, okay? You study behavioral analysis to understand where we're at in the market cycle. Is this the right time to really kind of look at investing in XYZ company, right? So it kind of answers that timing question of, is this the right time? The fundamental analysis answers the question, is this the right price? Are you paying a fair price to get into the investment? And then I say, but the most important level of analysis, and this is just my opinion, but the most important level of analysis is that of technical analysis, because that tells you when to actually do it, when to actually pull the trigger, where to put that stop loss, where to put the target. That's kind of leads that to the conclusion. Would you say that's a fairly decent way to describe to a basic person?
Absolutely right. And what we used to tell portfolio managers, especially newer portfolio managers, was there are plenty of bad times to buy good stocks. Yeah. And a lot of time, and the other one is that, there's a difference between a good company and a good stock, right? So a company is a story with a management team, with a product line, with catalysts for growth, with an earnings trajectory, all that, but you're not buying the company. You don't buy the earnings, you buy the stock, you buy the price. So if you don't analyze the price, you're missing a really important input with signal, with value that is going to basically have you, you're going to time things very, very poorly. And the other point, there's bad times to buy good stocks. We would always think of these two, fundamental and technical, in conjunction. We call it fusion analysis or something like that, where the fundamental analysis tells you what stories, what companies make sense. The charts are what tell you when it's a good time to actually pull the trigger on that. So if you have a list of ideas that make sense from a fundamental perspective, you look at the charts to identify what's actionable right now. And that word actionable is what we often came back to, because sometimes there would be a good story, but if you look at the price, it's just not the right time to pull the trigger. And the way that I would maybe put a little more meat behind what I just said is, if you look at the data for US equities going back decades and decades, multiple cycles, if you look at about a 6 to 12 month time horizon, in general, you want to be a trend follower, based on what works, right? So things that have worked tend to continue to work over that time frame. Things with a strong 12 months tends to do pretty, or with a weak 12 months tends to underperform on average over time. Shorter term time frame, if you're looking a couple weeks down, you actually should bet on mean reversion, because whatever has gone up in the short term will tend to swing back, and whatever's been low will tend to go up. So if you think of the two of those in conjunction, that is what I think is the sweet spot, which is a good, strong, long uptrend, something like a Visa or MasterCard, which has been a consistent outperformer, good chart, But then you look for when it pulls back a little bit, and that's sort of the fat pitch. That's something you'd have to take a swing at, where it's good long-term trend, but weak short-term, which means it's more actionable, more opportunistic moment. Looking for that sort of combination is in line with what the data would tell you for stocks going back multiple decades.
All right, I have a burning question. This is the perfect time to ask it. All right, let's take Visa, like what you just talked about. I imagine you deal with a wide variety of people that have different time frames in their outlook. Like some are short-term, some are long-term. All right, Visa, one of the clearest uptrends you're going to find in the market over the long term. Just nice, steady uptrend.
Sure.
And you talked about actionable ideas about that point to get into a trade or get into a position. How do you differentiate when you're teaching different people with different time frames when those actionable points of entry would be on a nice uptrending stock, clear uptrend? Visa's pulling back today. So how do you teach, because you deal with people with short terms, people with long terms, how do you approach that technical entry, that actionable idea on a situation like Visa when it does pull back?
Yeah, so you hit on a perfect point, and I would say there are a series of chart crimes that I see people do, and one of the main ones is having a chart time frame that's not in conjunction with your investment horizon, right? So in general, if you're looking to bet for the next month, if that's sort of your average holding period, 3 to 4 weeks, then I would say you need to be looking back at least 6 to 12 months of history to sort of do that. But if you're looking for a year down the road, you can't look at that same 1 year chart because you're not looking at enough data to really understand the right time frame. You need to be looking at like 5 years down the road or maybe a little more. So it's all about, from a technical perspective, it's all about identifying sort of your average time horizon and then using enough data or the right time frame, whether it's like a weekly or daily chart or an hourly or 5-minute chart, depending on where you're trying to win. What's your horizon where you feel like you're trying to win? Once you've defined that, once you've defined your time horizon, then you can start to look at the analysis that makes sense with it. And it's all about, for me, short-term and long-term might mean something very different from you. If you're a short-term investor, I'm a long-term investor, right? So it's all about identifying that the first question is, what's your horizon? Then the questions after that are, trying to get into the right timeframes for it. And so in general, what I've often asked people to do is, when I first start working with them, show me an example of your like sweet spot. What was your best trade in the last 6 months, last 3 months, whatever it is? How did it actually play out? Where did you get in? Where did you get out? Why did you do that? And by doing that, we can immediately hone in on sort of their idealized, action, idealized chart, and then we can start to look for more things like that. The second question, and much more painful, is what was your worst decision over the last 6 to 12 months? And let's look at that together. And there you start to find where there might be gaps in the process, right? Where you might have missed something. You don't have a good stop routine, right? So you have a good entry discipline, but not a good exit discipline. And by going through that exercise, even on your own and just doing it regularly, you will uncover sort of strengths and weaknesses in your own process and hopefully start to improve that.
David's much more caring in his answer. I was just going to say 150. I was going to say.
You used a phrase there that I loved, chart crimes. What are some other chart crimes?
He's going to steal that one too, David.
Yeah, I was already stolen. That's so stolen.
Signed like an NDA before this or something.
You're a chart killer.
There are a number, and so there's for people that like to read, there's a number of books by Edward Tufte, and his last name is Tufte, Tufte, and he is widely known as like one of the experts on data visualization, not just financial data, but all sorts of data. And he's used a lot of times. He's asked to give feedback on things. And at Fidelity, we had such the luxury of this chart room, which is a physical space dedicated to market history and technical analysis. Huge wall-sized paper charts going back hundreds of years, and also really cool digital signage, touch screens, and really cool stuff. And it was really fun to sort of experiment with what we could do. But we often would go through this list of potential chart crimes to make sure that we did not violate them. Other ones that would come to mind would be unlabeled data sets. So you have a chart and it shows 2 lines and you compare line 1 to line 2 and you say, so this is why Visa is good, but then you're not really articulating, hold on, what time frame am I looking at? What is the x-axis? What is the y-axis? Where did you start the point? The second chart crime would be, I would say, using a start date that's nebulous or borderline dishonest. So for example, if you think the US market, bottomed out Christmas Eve of last year. But a lot of times, if you start a chart at the wrong time, you'll ignore the meaning. I would argue most charts of stocks, if you're looking at the last year, should be started on that point. If you're looking at relative movements, because that was the bottom, that's everything sort of evolved from that point. But if you take a start date a little after that, things will look a little better or worse depending on where you started. So that's another one. And then the third thing, probably the most common, is comparing one chart to a different chart. You'd call it like a price analog. So let's look at Bitcoin now versus the NASDAQ 100 in 1998 or something.
Makes no sense.
And what you're doing there is a statistician would laugh you out of the room if you show them that. You're comparing one observation to a second one, and drawing anything from that is
It's
really
arbitrary at that point.
You're more creating a narrative than actually looking at the evidence.
The stat nerd in me is going to bring out statistical significance. So as a chartist, is there a minimum points that you have before you assign statistical significance to your analysis?
Yeah, really good question. So I would say in general that it goes back to the CMT exams, right? So when I went through and learned all the parts of the toolkit, part of that journey you go on is trying to, refine your own toolkit. And in the end, it's what's Dave Keller's approach to analyzing a stock. And so part of it is using the techniques that people have tested and have developed over the years and that have stood the test of time. So what's worked, what's robust enough to work in different cycles and different environments, not something that's just going to work today and then be gone if the market changes a little bit. And so if you, and for me, the second thing would be things that are readily explainable. So I don't use anything that's so esoteric that if you and I sat down and looked at a chart, I wouldn't be able to easily explain, here's what it is. It's sort of the call your mother. Can you explain to your mother, here's what this chart is telling you? And if not, you probably shouldn't use it. Peter Lynch always said, you want ideas you can illustrate with a crayon. And I think that's how you would think of this as well. So for me, when I'm looking at a stock, I use techniques that are consistent, that have stood the test of time, that have worked. So in terms of statistical significance, it's generated alpha over multiple years, multiple cycles. So I don't have to worry about, is this really robust enough to work? And what happens a lot of times is people will backtest something for the last year, the last 2 years, and say, all right, great. Here's a fantastic system. It returns 70% over the market. Fantastic. And then it completely crashes. And so, friends of mine have often said, I've never met a back test I didn't like. I mean, they all look good, but they're never, very few of them are robust enough to actually.
You have to back test any system. You got back test systems on different time frames and different economic conditions.
Yes.
If you just cherry pick, hey, I'm gonna go back test a buying call options type system in 2017 when everything went up 24%, then yeah, your data is going to look good. And if you're going to go back test bearish trades in November and December of last year, it's like, yeah, we're hitting 90% because everything went down. You can't choose your test. You have to back test through different time frames. David, I got one last question for you, and we can talk about it a little bit because I think it's important. You mentioned just a little bit ago that there's times when you have great companies, but it's a bad time to be a buyer.
Sure.
Is this one of those times, David? Are we sitting right now, June 2019, markets showing double tops, we had market volatilities increasing, trade war significance, slowing growth around the world, we're approaching another earnings season. Is this one of those times where you're like, this may be a time where we have great companies, but not the best time to look into them?
So the short answer is yes. I think it's one of those times where it's a bad time to be looking for long ideas. And I'll give you the longer answer then, because to be honest, I talk a lot with my peers in the industry that are technical strategists and behavioral strategists, and I would say there are times over the years when many of us have been in agreement, and this is not one of those times. I would say it's a pretty polarizing moment where half of the people I talk to are saying this is the most buyable dip ever. This is a chance to buy good companies at a discount. FANG stocks are down significantly. Like, get in today when they're down so much. And I'm definitely in camp number 2, which is thinking I'm looking at a big double top. I'm looking at, and again, headwinds, for macro headwinds, I would argue there always will be some macro headwinds that could drive prices lower, and that is going to happen, I think, right? But it's more about the action that you see from stocks. So from a macro perspective, what are the charts telling you? Then all the way down to the micro perspective. And for me, there are 3 charts I was sharing with my clients in the last couple of weeks. I called it the Trifecta of Bad. And there were 3 sort of big picture charts that I think illustrate the negativity that we've seen. and I'm happy to share them. The one of them would be the relative performance of semiconductors relative to the S&P. What's interesting is today, which is kind of a down day in the market, semiconductors are actually one of the groups that are up a little bit. But overall, the relative performance of semiconductors has rolled over pretty significantly.
Mm-hmm.
Now, while the market has rallied occasionally without semiconductors, it's super, super rare. And if you're going to bet on the probabilities, I would only be happy to be long when a group like semiconductors is doing well, because that tells you there's a lot of momentum, a lot of positivity to be had in a lot of different industries. It hasn't happened. So until you see that start to improve, I think you have to be skeptical. The second one would be small caps relative to large caps. So in general, in a bullish phase, you'd want small cap stocks, something like the IWM, to outperform the spiders. That relative strength has been, dramatically lower over the last couple of months.
Oh, it got slaughtered last year, and the recovery hasn't been.
It's never gotten better. So this has been a market that's been led by the big, mega cap names and not the smaller, more speculative names. So until that improves, I think you have to be skeptical. Mm-hmm. And then the third one would be more offense and defense within consumers. So if you look at consumer discretionary versus consumer staples. Mm-hmm. In general, that tends to go up in bull phases, tends to go down in bear phases. That ratio has been rolling over and it's just recently broken down, which tells you that, within consumer, the flows are going more towards the defensive stuff like toilet paper and alcohol and staple type of products, as opposed to more speculative, retail goods. And I mean, one of the worst charts you'll see is something like the XRT, the retail index, which has just gotten absolutely clobbered. So those three charts, it's hard for me to feel constructive on the market when those three charts all have rotated lower so dramatically. Until you see them improve, I think you have to be pretty skeptical about it. Having said all of those things, I think you hit on it a little bit, which is we're in the seasonally weakest part of the year, and that we sort of saw on the horizon. We approached previous highs leading right into May, and right on schedule, the markets rolled over, and May through October, November is traditionally the weaker part of the year. So in my opinion, I think it's worth waiting until you start to see, the technology, consumer discretionary, other leadership start to improve, and that's where you start to look for.
I always try to be open-minded when it comes to having your belief system about where this market's going to go in the future, because there's many, many, many different variables, and many of those we just don't understand even ourselves.
Sure.
But I would certainly be in camp 2 as well. David,
you missed your call. Listen, forget charter market technician. You missed your calling in marketing. Trifecta of Bad, chart crimes. You're like, seriously, like a marketing agency.
I'm thinking about creating products off those three things. Just
and David, I can promise you in a few months, I'm going to beg you via email to come back on the podcast. This has been fascinating. I feel like I've gotten smarter, and me and my brother are arrogant, egotistical, and I'm like taking.
Nice to say that about me too, just to make yourself feel better.
He did not hesitate to throw you under the bus.
No,
this has been great stuff. Like
earlier's like, I'm not going to throw my Fidelity, friends under the bus here. Mark's like, yeah, he's an egotistical son of a bitch.
David, this has just been great stuff. The analysis is great, man.
Anytime we can bring on somebody onto the podcast, meet new friends, like-minded individuals, and I sat back and listened, and David, honestly, I learned something here, and I hope the listeners do as well. David Keller's been absolutely awesome having you on the Trading Justice podcast. David is the president and chief strategist of Sierra Alpha Research. He's also has a blog over at marketmisbehavior.com. David, if anybody wants to read your blog, get in contact with you on Twitter, anywhere else you want to plug yourself a little bit.
Yeah, thanks, guys. And listen, thanks again for the invitation. Really, really good to meet you guys. And I hope this is the beginning of a great relationship. Look forward to
We are absolutely doing this again, David. This is awesome.
Yeah. Best place. Yeah. My blog, Market Misbehavior. I love to unpack the relationship between behavioral psychology and investing. I think there's so much for, especially individuals, advisors, others to learn from that. So I love sort of picking apart different ways to think about how you come to decisions. And then the second place you can hit me on Twitter, dkellercmt is my handle. And then finally over at stockcharts.com, I write a regular blog called The Mindful Investor. So would love to engage with all of your listeners on any of those places.
Awesome. We'll be right back with more from Trading Justice after these words.